Picture this. You own the most valuable commodity on the planet. The price just hit $100. Your buyers have the money, your product is ready to ship, and you are about to post the worst financial quarter in 30 years. That is not a riddle. That is Saudi Arabia right now. Here is what happened in the last 72 hours alone. A fragile ceasefire was announced between the US and Iran. Markets briefly celebrated, and then, within hours, satellite imagery circulated, showing thick black smoke rising from Abqaiq, Saudi Arabia's most critical oil processing facility on the planet, the plant that processes roughly 5% of all global oil supply. The ceasefire had not even been tested, and Saudi Arabia's last working export backup was already going up in smoke. The IEA has called the current Hormuz disruption the largest oil supply shock in the history of the global oil market, not in recent history, in all of recorded history. The Strait handles 20.9 million barrels per day, roughly 25% of all seaborne oil trade globally. Right now, that flow is running at below 10% of normal volume, even after the ceasefire. As of yesterday, Bloomberg confirmed that Saudi Arabia's crude exports to China are heading for a record low in May at just 20 million barrels, down from 40 million barrels in April, down from 48 million barrels in February before the Hormuz disruption began. In less than 60 days, Saudi Arabia has lost more than half of its most important customer relationship, a relationship that was generating $4 billion per month for the kingdom. And sitting inside Gulf sovereign wealth funds right now are over $300 billion in US Treasury bonds that could enter the open market if these economies get squeezed hard enough. In the US, inflation has already climbed from 2.4% in February to 3% in March, a two-year high. That number was measured before the Abqaiq disruption and before Saudi exports to China were confirmed to be halving. The Federal Reserve's own modeling projects global GDP could contract by 2.9% in the second quarter of 2026 if the Hormuz situation continues. That is a contraction on the scale of a major global economic event. Energy pricing is not one variable among many. It is the base cost of everything. Transport, manufacturing, food supply chains, logistics. When the base cost moves sharply upward, every price in the economy eventually adjusts to follow. The world is entering a consumption contraction, and this is the full picture of who pays for it. Not every country absorbs this equally. The United States has structural protection. American domestic oil production is large enough that elevated global prices hurt consumers at the pump, while simultaneously benefiting the domestic energy sector. That is a painful trade-off, but an economy with enough diversification can manage it. China is also comparatively insulated. Beijing does not rely heavily on oil and gas for its power generation. Renewables, nuclear, and coal supply the majority of Chinese electricity, and China has the most strategically convenient alternative oil supplier on the planet sitting directly to its north. Russia has been supplying discounted crude through arrangements established since the Ukraine conflict, and those arrangements are fully operational and expandable. The Gulf is in a completely different position. Oil and gas still account for close to a quarter of total GCC GDP. Government budgets run almost entirely on crude revenue. Gulf currencies are dollar-pegged, which removes the exchange rate as a tool for absorbing revenue shortfalls. And the populations of these countries live inside welfare systems that are not optional programs. They are the foundation of the political relationship between governments and citizens. Kuwait shows exactly what is now at risk. The Kuwaiti government runs one of the most comprehensive citizen welfare programs anywhere in the world. Monthly child allowances flow to families. Young couples receive government grants to buy or build a home. There are marriage grants and pension payments that cover living costs several times over. The entire system runs on oil money, and there is no tax base large enough to replace that revenue if it stops arriving. Goldman Sachs has put specific numbers to what a prolonged disruption means. If the Hormuz situation effectively halts oil and gas flows for a 2-month period, Kuwait and Qatar could each see GDP contract by 14% this year. The UAE is projected at roughly 5% contraction. Saudi Arabia is estimated at around 3%. Oxford Economics has downgraded the entire GCC aggregate growth forecast by 4.6% to negative 0.2% for 2026. That is a regional recession and the worst GDP decline across the Gulf since the early 1990s. Dubai's stock market has already dropped 15%. Markets in Abu Dhabi and Qatar are down between 5% and 10%. The UAE suspended trading on 2 consecutive days in early March just to stabilize markets before things got worse. The financial pressure across the Gulf is not hypothetical. It is already showing up in every market indicator in the region. Here is the cruelest part of this entire economic situation. Oil is near $100 a barrel. Brent crude is around $97. West Texas Intermediate is near $99. These are the prices Gulf producers spent years hoping to see. The fiscal break-even price for Kuwait, the minimum oil price needed to balance its national budget, is $82 a barrel. For Saudi Arabia, it is approximately $83. At $97, Gulf governments should be running budget surpluses. Vision 2030 should be fully funded. Sovereign wealth funds should be growing. Instead, the region is heading into recession. A barrel of oil is only valuable when you can physically deliver it to a buyer. The strait that handles the exit for 1/5 of global oil supply is functionally closed. Pipeline alternatives handle only 17% of the flows that would normally move through that waterway. Saudi Arabia pivoted by redirecting exports through the East-West pipeline, routing crude from the Abqaiq processing complex across the country to the Red Sea port of Yanbu. By mid-March, the pipeline was running at 80% of maximum capacity. Yanbu shipments tripled from pre-crisis levels. Saudi Aramco's CEO called it the biggest crisis the region's oil industry had ever faced. The target was 7 million barrels per day through the Red Sea. Then, hours after the ceasefire was announced on April 8th, the East-West pipeline was disrupted by an unmanned aerial vehicle incident. The damage reduced Saudi production capacity by around 600,000 barrels per day and cut pipeline throughput by around 700,000 barrels per day. Abqaiq, the facility processing 5% of global supply, was visibly impacted in satellite images released that same day. Saudi Arabia has since restored the pipeline to full capacity. But the lesson is clear. The backup route can be disrupted at any point without advance warning. Any supply chain, depending on, it is operating under permanent uncertainty with no guarantee of continuity. The result is that Saudi Arabia is now boxed in from every direction simultaneously. The primary export route, China, is making the rational decision that any major buyer in this situation would make. It is redirecting its supply chains away from the Gulf, and it is doing it fast. Bloomberg confirmed on April 13th that Saudi Arabia will ship just 20 million barrels to China in May, down from 40 million barrels in April, down from 48 million barrels in February, a 58% decline in the kingdom's most important commercial relationship over the span of roughly 2 months, a record low and still deteriorating. The revenue impact is direct. When China was buying 40 million barrels per month, near $100 per barrel, that single relationship was generating approximately $4 billion per month for the kingdom. The projected drop to 20 million barrels eliminates roughly $2 billion of that monthly figure. With Hormuz conditions making even that delivery level uncertain, the actual revenue loss is likely larger than the volume figures suggest. There is a pricing problem compounding the volume collapse. Saudi oil to Asian buyers is currently trading at nearly a $20 premium over the benchmark price. Buyers are paying $20 more per barrel above the standard reference rate just to access Saudi crude. This sounds like a revenue boost for Saudi Arabia. It is not. A $20 premium is a direct market signal for every Asian buyer to build permanent alternative supply arrangements. It makes Russian crude cheaper by comparison, Malaysian and Brazilian barrels more competitive, and accelerates exactly the structural shift away from Gulf oil dependency that China was already pursuing before this crisis started. India follows the same pattern. Saudi shipments to India have declined from 25 to 28 million barrels monthly down to approximately 23 million. European refiners are reporting reduced or zero Saudi crude allocations for April. Aramco has declined to comment publicly on any of these figures. The oil market does not wait for disruptions to resolve. It reroutes within weeks. Russia is the single largest beneficiary, with established Chinese payment infrastructure in RMB and scalable supply. Malaysia sits geographically close to China with no supply chain complications. Brazil, as a BRICS partner, doubled its oil supply to China in March 2026, reaching over 1.6 million barrels per day. That trade is almost certainly settled in RMB rather than dollars, adding to the ongoing erosion of the petrodollar arrangement. Is functionally closed. The backup route operates under continuous threat. Oil prices are high, but the revenue is not arriving, and the most important buyer is heading for the exit. The oil trade shift is the most visible dimension of China's withdrawal from the Gulf. There is a second dimension receiving almost no coverage: Chinese investment, and its long-term consequences may be deeper than the trade disruption. Since 2018, Chinese capital deployed into the Gulf increased by nearly 50%. Total Chinese investment across Gulf states now approaches $270 billion. Saudi Arabia specifically has received $82 billion of that total. More than $50 billion worth of Chinese-backed projects inside the kingdom are actively under construction right now. That $50 billion is facing genuine uncertainty. Chinese firms operating in the kingdom are navigating a disrupted environment, delayed logistics, and uncertain project timelines. At some point, the internal question in Beijing shifts from how long a project takes to finish to whether continuing to fund it makes any strategic sense at all. There is also a longer-term structural shift underneath all of this that has the most permanent consequences. China is not just rerouting current oil purchases. China is actively accelerating its transition away from oil dependency as a national strategic priority. Clean energy industries including solar, wind, hydro, and nuclear now account for roughly 1/3 of China's total GDP growth. That is the primary engine of the world's second-largest economy. Every month of reduced Hormuz flows is another month of political justification inside Beijing for faster domestic energy build-out. Every additional unit of domestic Chinese generation capacity installed is one fewer barrel of Gulf crude that China will ever need to import. The assumption built into Vision 2030, stable and growing Chinese demand for Saudi crude for years to come, is being revised in real time by the purchasing decisions of Chinese state-owned refiners. And then there is the financial dimension that connects the Gulf's pain directly to the American economy. Gulf sovereign wealth funds hold over $300 billion in U.S. Treasury bonds. Saudi Arabia alone accounts for nearly $150 billion of that total. This is the petrodollar system made concrete. Oil revenue comes in as dollars. Those dollars get recycled into U.S. Treasuries. That recycling keeps American borrowing costs lower than they would otherwise be. But it only works as long as Gulf governments have enough oil revenue that they do not need to liquidate those bond positions to fund domestic obligations. If the revenue shortfall is deep enough or long enough, selling treasuries becomes not a policy choice, but a financial necessity. And $300 billion of treasury bonds entering the market in an already stressed bond environment would push U.S. yields higher and raise borrowing costs across mortgages, corporate debt, and government financing worldwide. Will China's departure from Saudi oil become a permanent structural shift? Will Gulf governments be forced to begin unwinding their treasury positions to stay solvent? Drop your analysis in the comments below. Hit the like button if this gave you a clearer picture of what is actually moving underneath the headlines. Subscribe for daily coverage, and we will see you tomorrow.